Hey everyone, welcome to the Note Investor Podcast. I'm Dan Deppen, and today I'm joined by Fred and Tracy Ruiz. So Fred, Tracy, how you guys doing?
Good,
We're
good.
doing well. Thanks for having
Yeah,
us.
thanks.
Yeah, I'm glad you guys could be on. So I know like just recently you guys released your newsletter with like a whole bunch of data on seller finance, which I found like really interesting, and I had a bunch of questions about it. So I thought the easiest thing was like to invite you to do the podcast, and then I can get my questions answered and get really good material for everybody. So
Well, that's what's so great about this format, right?
Right,
You get
yeah.
to ask the questions and we get to share it with everybody.
yeah, it's kind of nice. Like half my episodes are just things that are like on my mind or like people I want to talk to. So it's a nice vehicle. So maybe guys, for people that aren't familiar with you guys, you can just give us like a little bit of background on what y'all do.
Go ahead.
Well, we buy seller financed real estate notes. That's why we have been tracking this data. I got started in 1988 working for an institutional investor, did that 10 years, had the entrepreneurial bug, wanted to buy notes for myself. And so started a company in 1997, co-founded by Fred and I, and he got into the business a little bit different. So I'll let him explain that.
Yeah, I was actually just trying to, I was 3 years after Tracy, so she has 3 years more experience than me that, comes up quite often. You'd be surprised. No, so I started in 91. I was trying to figure out how to buy real estate in California where I lived at the time. And a gentleman by the name of John Richards, who was teaching a class I took, and he taught notes in that class.
In a community
And a
college.
community college. And I just thought that was the coolest thing. And he taught me
In
to calculate.
1991, it's like somebody was teaching that, and that's
Oh, yeah.
crazy.
Oh yeah, no, he'd already been doing it for quite a while.
He's a legend.
So yeah, so I learned from him, and then we did some deals together, and then I kind of went on my own, and then like Tracy said, we met and we started our company. We had both worked for a large corporation, but the only thing we couldn't do was buy notes for ourselves. It was kind of a conflict of interest. So we started our own company. We walked from it in 97, started our own 97. Yeah, 97, started our own company, and have ever since. So we love, I mean, we love the note industry. This is what we've done our entire lives pretty much. And at this point, and
It introduced us to each
it
other.
did, yeah.
So
Yeah. I meant to say that was can we start over? Can I lead with that? So anyway, but we know we love the
I could always do some
flexibility.
selective editing. Yeah, we could switch through
It's
it.
all
Yeah.
the coolness of real estate without actually owning the property. And for us, from a lifestyle standpoint, particularly a couple times in our lives where we've decided we wanted to be more mobile, we wanted to go travel more, we wanted to be, still be able to run our business. It's been a great fit across the board. So what we do every year is we track the numbers. And you want to talk about how we get a hold of the numbers?
yeah, it's interesting. Back when we worked with the institutional investor, we would do these research papers and we try to, like, white papers, and try to figure out how much seller financing is there. And we sample information, and we were like, well, we think it's somewhere around 3 to 4 to 5%, depending on what part of the United States you're in. And then along comes the internet and online recording, and most of the counties now dump their data. You can purchase the data to see what deals are seller financed. So note investing takes all forms, as you know, Dan. Some people like to buy the scratch and dent. Some people like to buy the non-performing. Well, we like that sweet spot of seller finance notes because we like the discount. We like dealing with the individual deals rather than great big portfolios. So this seller finance data is when somebody owned the piece of property, they sold the piece of property, and they allowed the buyer to make payments to them as the seller instead of going out to get a bank loan. And that seller's getting these payments over time. And at some point, they might want to sell the note to somebody like us or somebody like you or your listeners. So what we're tracking here each year is the data of seller finance deals. What percentage of those are of all the deals that are done either for cash or bank loans or traditional things like that? How many sellers are allowing buyers to make payments? And that's what we track every year.
So I don't know, maybe you can't say, maybe proprietary, but like, how do you find that data?
We are
That
going
seems
to
like a hard
tell
thing.
you exactly how we find it. We're going to show you how we do it.
We buy the data
Yeah.
from a data provider that we've known for decades, and he's been tracking the seller finance data as well. So we'll be happy to share that.
Yeah, we'll show you exactly what we do.
So we do have a slide deck. You want us to give a little?
Yeah, go ahead and share.
All right.
And if people are listening on the podcast, this will also be on YouTube. So if you want to see the visuals, you can go to the Fusion Notes YouTube channel to see it.
Yeah, that's a really good point. Because
thanks for the reminder, because we'll try and say as much as we can what's on the screen or what we're going
through.
through.
This is definitely one that it helps to have a visual. So what we're going to cover today and at our time here is we just want to talk about exactly what were the trends in last year. Now, this is through the end of last year, but it takes us a few months to get all the data because you have to pull it from the county records, and it does take a little time to compile that. Fred always teases me, I'm impatient, I want it on January 1st. And I'm like, no, I'd wait till January 3rd if somebody, but really it takes about the middle of March before.
And aren't some of those county records still kind of manual? Like I know when I've gone through,
There
like,
are,
like
yeah,
some
but it's
counties are really easy, others are kind of challenging.
it's much smaller. Matter of fact, we'll talk about that when we categorize some of them, because we actually have those in a bucket to account for that a little bit.
Yeah, this is about 2,200 of the 3,000 some counties. So we don't have all the data, but all the bigger counties tend to report. It's this really tiny counties, like you mentioned, that don't.
Yeah,
And there's probably
We'll talk
not
about-
as much activity there anyways, right? So,
Exactly.
We'll talk about the average note amounts, so everybody knows on average what is the amount of the note and what are the loan to values on the notes that are being created.
And we'll look at by property type, because it's not just residential, it's also commercial land.
Yeah,
Mhm.
we'll talk about the 10 hottest states, if you will. We always compile a list. Well, once we have the list, we know which states, how many notes were done in every state. And we know who the top 10 states are. And the top 10 states actually account for 60%, 7% of the volume, oddly enough.
Yeah, when we get into it, like in a little bit, I had some questions about that too. and
Yeah,
why,
for sure.
why those states? Yeah.
Yeah.
And then we like to always look at, for our marketing purposes, the mom and pop sellers, those doing just one every 12 months compared to what we call seller financing pros, that group that's doing 2 or more in a year.
Okay.
And we'll talk about what's happening this year. You know,
And-
a little easier to predict because we're already several months into it, but then you don't really know for sure. But we'll talk a little bit about this year. So the first thing we'll talk about really is how big is the owner finance market, and this is the number I think that really just always amazes everybody.
There was 28 billion with a B of seller finance notes created in the calendar year 2023.
So what we do is we tend to keep a trailing 5 years. So we figure, not all 5 years of that is viable. Some of it has already been bought by investors. Some are people that haven't sold and weren't ready to sell yet. But the trailing 5 years is $125.5 billion worth of seller carryback notes created. And we're going to talk in just a second of what that is. That's over $30,000. And we're going to talk about what size notes those are. But basically, that's all. It's a bigger market than people realize. And as Tracy said earlier, when we didn't have data to do, the estimate was somewhere between 3 and 5% of all real estate transactions were seller carryback notes. And that seems to be about in line when you look at the actual real estate sales versus what numbers we have here. We're pretty much in line with that.
And that is larger than what I would have guessed, like
Yeah.
with no data, just because like you even talk about, even when you talk to like real estate professionals, like a lot of times they don't even understand what seller finance is or that
Right.
it's even a thing.
Right.
Yeah.
Yeah, you're like, it's everywhere. When I speak to real estate investing groups, that's the first stat I pull out. There was 28, there's 125 billion, there's 28 billion in the last year. I always have that number handy because I want them to go pay attention, because and I always say with a B, because they always go, whoa, yeah, that's a lot more than I realized. So
Yeah.
it makes them want to learn more. So guess what? When you look at 2023 compared to 2022, we were up 24.2% in dollar volume. And when you look at the count, like the number of deals that were seller financed, we were up 7.3%. So we had a big increase from the prior year.
Yeah. So that one surprised me. I'm curious why that is, because I don't remember the numbers, but like I follow some other economists that report general like housing sales data. And I don't know that like the broader market, I don't think was up
It wasn't
like
we're
that.
We're
So
going to
like
talk
my
about
question
that.
was like,
Yep.
why seller finance specifically?
That is a great
Curious.
question.
Yeah.
Yeah.
We're going to drill down on that. So the top 5 states were Texas, Florida, California, North Carolina, and Georgia. And we'll go into that a little bit later in more detail. And residential and commercial had the largest increases in owner financing. The third category, land, had the least. But land, we saw a spike several years ago, which we'll see in a screen in a little bit here. But land had a spike several years ago as the developers were probably acquiring more land. At least that's some of our theories on it. And now now they're building on that land. So they're not in that land acquisition mode. But basically, let's talk a little bit about what's behind the increase, because Dan's pointing out right now, which is very valid, is, wait a minute, we thought home sales were down, and they were significantly down, especially over the last 2 years.
Yeah,
Mhm.
so the year 2021 to 2022 home sales were down, and seller financing went down about the same percentage. It kind of followed the sales, like you mentioned, Dan. But this year, while the sales were down over 18% in the existing home sale market, we saw they're up in the seller financing market. And while the home sales were down over that 18% and had the weakest year since 1995, we had one of our best years in the last 10 years. And so why is that? Well, it has a lot to do with the Mortgage Credit Availability Index. And that's where this chart came from. It comes from the Mortgage Bankers Association. What this is in a nutshell is they say, how easy or hard is it for somebody to go out and get a loan from a bank to buy their home? And when that index is high, when it was cranking along at 185, it was easy to get a home loan. Now it's down to 92.9. It means it's hard to get a home loan. Well, why is that? Well, we see it dropped off when COVID came along because all the banks went, we don't know what's going to happen. We got to tighten up. They tightened up their underwriting. They wanted higher credit scores, more down payment. And then along comes higher interest rates. And then that availability drops again because what happens, rates go up, payments go up. And what happens is people can't afford as much of a home. Their debt to income ratios go up. And all of this is happening. And the banks are just tightening up, tightening up. They don't know rates are going to go. They got stuck with all this low interest rate paper. And so it's harder to get a loan. And when it's harder to get a loan, there's more seller financing. We've watched it over our 3 decades in business. And whenever it's harder to get a loan, there's more owner carry paper being created.
And I believe, correct me if I'm wrong, the seller finance notes, those are still supposed to be Dodd-Frank compliant, right? So is it that the banks will just have tighter restrictions? So like the banks have requirements that are like kind of beyond what Dodd-Frank is. So with seller finance, they're still meeting Dodd-Frank, but it's like maybe less stringent than what the banks
Yes,
would demand. Okay.
that's right.
Gotcha.
Yeah, so we always pull this chart. We're always looking at it, and that's, part of our predictions for the future as well, that chart. It hasn't been that low since after the subprime mortgage meltdown. So that's why we're seeing it now. And that, interestingly enough, as this chart shows, is when we last saw the big increase in seller financing was after the subprime mortgage meltdown when mortgage credit bill availability was tight. And now we're starting to see that again. It takes some time for that to catch up.
I think you covered it. Yeah. I mean, if you were to overlay these 2 slides together, one which showed our credit mortgage availability index and the other one shows our dollar volume, you can see that it trails. You can see that as things tighten up, as interest rates go up, or if there's something else in the market, if it's inflation or something else like that you put over the chart, you can see as those tighten up, seller finance does go up. The good news is that, in either market we do well. If the economy's going great, then people are creating notes and wheeling and dealing and selling notes, which is great for our side as investors because they want to move on to other projects. They want the cash to move on, reinvest in something else. If inflation is tough or the market's tightening up, then people are selling it on a necessity. They want to unload it because they're either worried about holding onto that note or they unload it because they need some access to cash. So in either way, we do well. But even as you can see, as we been able to track it pretty well for the last several years, it's still plenty big enough regardless of what the market's doing. We don't panic when interest rates go up 300 basis points. We don't panic when they go down because it doesn't matter. There's still enough deals on the table. What changes for us is largely the mentality and who we're dealing with as a seller of a note.
Oh, one question I had was like, who in the heck is like originating these 89,000? Like I know like every now and then I end up with an REO and I create a note and like I use Max Bailey from Call the Underwriter to do the underwriting.
Great suggestion.
But he can only do
like
so
him.
many, and there's only like so many people out there that do these. I'm like, how are these getting originated and put together? Like it seems like almost like, are we going to hit a limit where just the ability of the vendor ecosystem like to keep up is going to get strained? I don't know.
I think that it'll fill in. Look, think of all the mortgage brokers and mortgage bankers and loan originators that got laid off when interest rates went up and they weren't doing refinance anymore. I mean, I think there's plenty to draw from if we need more.
Yeah, makes sense.
I do want to mention before we move forward, you had asked earlier, and it's a good time to probably address that question, is where we get the information and also what these notes are that we're talking about. So first off, the notes that we're talking about here that are all part of these numbers, these are all seller finance. So these are sold by a person, sold, to another person. It could be a business to business, could be commercial, could be residential. We'll talk about in a second. They're all first positions or they're wraps. They all have a balance of 30,000 or greater. And like Tracy mentioned, we have about 22, almost 2,300 counties report on it. And one of the biggest sources we have is Advanced Seller Data Services. And that's a company that's made a business out of getting the names from courthouses and from all the recordings and things like that. So we get that data and, we can sort and search and, by sizes, we can sort by dates, we can sort by a whole lot of things, entities, which we'll talk about in a little bit. But that's one of the biggest sources we use to be able to create all this information.
So they're basically like stripping out the banks. So I guess you've still got LLCs and stuff to some degree, maybe, but yeah.
They look to see who's vested in fee simple title. Is there a deed recorded and right after the deed, a mortgage or a deed of trust are recorded? So there has to be a deed that goes with the deed of trust. When a bank makes a loan, they're not vested in title. So the bank doesn't give a deed and take back a mortgage unless it was an REO property.
Gotcha. Okay.
Yeah, good question.
So if we talk about owner finance by property type, and again, this is just 2023. So just to break it down, and this is going to start to make Dan, I always look at the numbers as really, really high. And as we drill down, especially when we get the number per state, it all of a sudden becomes a manageable number in my brain, because in the beginning, it's such an overwhelming number. So we're not there yet, but we're getting closer. Residential, it was $14 billion of the entire amount for this. So it's roughly 50% of the dollar volume that goes into what was created last year. And it's 56,352 transactions, which is roughly 63% of the transactions. So residential's always the biggest form. It's always SFR or 1 to 4 unit, whatever it may be. But
Mobile
it's not
home and land.
mobile home and
But
land.
not mobile
Yeah,
home.
it's always the biggest category of what makes up that by property type.
And then commercial makes up the next largest chunk. It was 9.3 billion or 33% of the dollar volume, and about 15,142 transactions, about 17% of that volume. So it made up the next largest chunk.
Yeah, the next piece of the pie is land, which is always the smallest of all of them. It was 3.8 billion, roughly 13.6% of the entire dollar amount volume, and 16% of the transactions. It was 14,418 transactions. And then there's a catch-all bucket, because Tracy and I have to make sure that every number is accounted for as much as possible.
Yeah, and so this is just when the counties reported, it wasn't easy to pull the data of what kind of property it was that was seller financed. So we know these were seller financed. It's just about 3% that we can't quite figure out what the property type is, but we're pretty sure it breaks down about the same ratio as what you see for residential, commercial, and land.
Yeah, that makes sense. And one thing I noticed, like on the land notes, I've never done land notes yet. I've been looking at them, but it seems like I've seen a lot of them like the last 6 months.
Actually, we have two.
Yeah.
We have two, yeah. And we can talk about that from an investment standpoint. But what obviously, as we're going into as investors, what's the most secure? Well, a house. It's going to be easier for me to put somebody into a house. And then you get into land, and then it's like, okay, is it improved land, or is it somebody? The first thing to go when someone begins to stop making payments on something is that chunk of raw land they bought out in the middle of nowhere that they thought someday they were going to have utilities put to and maybe build a cabin on, because they saw a river runs through it and they want to do fly fishing the rest of their life, whatever it may be. So, that's the first one to go. So there's always less of those, but now, and again, I think this is due to inflation and stuff. That's the first one people are getting concerned with, starting to give up. Starting to try to, get rid of those land notes, whatever it may be.
New investor, we always say, go after residential first, commercial and land. We've done both. So there's opportunity there too. You just have to underwrite it a little bit more carefully. Yeah, when it comes to the property, the investment to value, the borrower, whether there's a personal guarantee, all those good things.
Yeah.
So this is very interesting. This is how we get to that $125.5 billion over the last 5 years. And this just shows how the numbers added up each year and how they've been going up. They were a little higher in 2021, then went down in 2022. And as we see, they're even more, came back stronger in 2023. But we just wanted to mention that residential went up by 17% in the dollar volume, and commercial, this is what's amazing, went up by 60% in the dollar volume, and went from 5.8 billion to 9.2 billion. So those two are the largest increases. And we can know why residential dollar volume went up so much, just because there's so much appreciation, right? But there's a lot of speculation on why commercial went up. And we really just think it's because there's more commercial lenders pulling out, and there's all this commercial loans coming due, getting rewritten, and it's harder to get a commercial loan, a lot of vacant commercial property. And so we feel that's contributing towards the seller financing.
Basically, because banks are already more risk averse to begin with. And so with, everything going on in commercial and the looming, like potentially like giant blow up that might be like in process. So then more of those loans, we have to roll them over, turn into seller finance.
Yeah, and I mean, post pandemic availability of office space became so much more. There was so much more on the market available. So now if you were going to, it may have been better for you to, new office space to rent it versus buy it. And if you were trying to sell it, it was hard for people to qualify because the interest rates and everything else. So people had to carry back more notes. It just makes sense that category went up as people were trying to move those properties. And one thing about commercial that we found interesting, because we were kind of watching a little bit lately, is that, people say, is everybody going to return back to offices? And I think we've already started to see a lot of that trend, but it's cheaper to buy an existing commercial property than it is to build right now, especially when we're still dealing with inflation or prices being back to where, whatever the median is. So that's why we're starting to see another spike in there, I think, as investors start to realize, hey, this is a good time to buy commercial at a discount, either a discount on prices or discount on terms. And if you can get someone to sell a carryback commercial, and you can cut off a couple basis points on your loan or get more favorable terms up front, that's big dollars in a commercial transaction.
Yeah, because there seems to be a big oversupply in commercial, particularly spaces like office space. And to your point with inflation, I'm assuming like building materials are more expensive, labor is more expensive. So why would you want to spend all that money in a, potentially already a kind of oversupplied market?
Yeah.
Now, why do you think, I'm curious about like, there was a spike in 2021, it kind of leveled off in 2022 and then spiked again in 23. I don't know if you have any theories on that. Like,
well, that was coming out of COVID. And so this is dollar volume. So we saw a lot of spikes just because of all the appreciation as well. And so that's why it's interesting to look at the dollar volume versus the counts. We always like to compare them both. Sometimes counts give you a more pure number, and dollar volumes can just naturally trend up as everything else is trending up. But we definitely, as Fred had mentioned earlier, there were a lot of big land sales we saw in 2019, 2020, and then they were subdividing that property. And now the land notes we're seeing are a little bit smaller in size. And that's a great question. It kind of leads into our next slide of what are the average sizes? Like that's a big number, but what about each individual transaction? What do those kind of numbers look like?
I think interest rates had a lot to do with that too. As interest rates are lower, then there was less need for seller financing if people were able to go out and get regular loans at a much lower rate. So if we look at the average note amount, this is interesting. And this is always an interesting one for me because it changes the perception of what people think of note investing. So when you're talking residential notes created, and again, we're talking about, me selling to you or whatever, the average note amount last year was $248,523. So it was up about basically 10% from the previous year. The average loan to value was 74%. So there's always this perception that, when investors are first coming into our industry going, I don't know if I want to buy in notes, thinking, they put no money down on the house, or it was 5% down, or, you have these, they're all poor credit, no money down. This is the average note here. The average note was walking in immediately with 26% equity. So this isn't a scenario where, why didn't this person qualify for a bank loan? And this is to your point earlier on what credit availability was. This person could have been self-employed or all of a sudden had a new job, or whatever it may have been. And banks freak out. I mean, the difference between our industry and other industries, anytime Tracy and I bring a deal to each other to look at, we're like, okay, give me a good reason to buy this deal. And you might look at the loan to value and go, wow, there's a lot of equity. You might look at it, they've been living there a long time. You might look at credit. You might look at it, they've done improvements. And the nice thing is we just kind of weigh them all together and go, well, you know what? They have poor credit, but they've lived there for 4 years, or they haven't lived there long, but they put a huge down payment. Banks don't get to do that. They literally, it either checks every box or it doesn't check every box, and it's a pass or fail. So this is a great example. I love seeing this number because always have people have this perception that they're all tough buyers or don't have any equity in it or don't have any skin in the game. And residential right here, they're 26% LTV.
Yeah, to me, it seems nuts that banks would not make a loan on a $250,000 house
Yeah.
at 74, 75% loan to value. I'm like, dang, like how conservative are, I mean, and it's good they're not going bananas and blowing themselves up. Like we don't want that either.
Right.
But I wonder,
We've been there.
so I wonder how much of that is the self-employment thing. I know at least during
A
COVID,
lot.
that was a big thing, but that's still something
We see a lot. There's a lot of, a lot of retired people moving, people cashing out of one area, moving to another area. They may not even have any income anymore. Maybe they're retired and the banks are like, I'm not lending to anybody who doesn't have income. So there's a lot of, there's surprisingly a lot of really good qualified, what you'd think would be qualified people fall into that bucket.
Yeah, and as you mentioned, if you make sure people have the ability to repay when they're living in the home, you still have to make sure they have income that can afford the payment, but you don't have to be as restrictive as what percentage that is.
right. They still need to be
bank is.
Dodd-Frank compliant.
Sure.
There's rules they have to follow.
Yeah.
These aren't like,
Yeah.
like the old, like early 2000s crazy loans that people were doing,
Yeah.
Sadly, though, there is a percentage of these notes being created, and that's when we'll get into talking about mom and pop versus seller financing pros. I mean, some people don't know to go check that the borrower has the ability to repay. And so that's an education issue that we're trying to have with people. I'm sure you talk about it a lot as well.
Yeah, the other thing I see occasionally with seller finance notes is like the buyer's not very sophisticated and they're comparing to rent. So basically the seller like sells it for too much and the borrower really doesn't have
Yeah.
equity. And it's like, yeah, that's sketch. Because if they ever figure that out or they have a problem, that's going
That's
to be
true.
not good. Yeah.
Yeah.
Very true. So we like to just finish out by showing the loan to value on commercial and the land notes as well. So the average size of the seller financed commercial note had a 41% increase. It went from 432,000 to 613,000. So then you asked about why did commercial go up so much? That you can see the size of the commercial deals went up quite a bit. And usually be some more seller financing the smaller commercial, but we're seeing that smaller commercial is getting higher now. It's not so small, it's kind of medium. And the other thing that we saw was the loan to value went from 66% up to 72%. So there wasn't as much down payments on commercial as there has been in the past, which could partially be due to the size of the deal going up, but also just that not as much money being put down when commercial properties are being sold.
Yeah, and the last category is the land. Not a huge increase on there. Basically, it was a 6.5% increase. So the average land deal was 263,871. It was only 6% higher than the previous year. The loan to value was 70% instead of 68. 2%, not a statistical anomaly. I mean, it just is what it is. I mean, you could second guess that all day long, but it's such a nominal increase either way. It doesn't really affect anything. So land was relatively stable year over year on that.
I don't know about you, Dan. All the land notes I've been seeing lately are either itty bitty,
Yeah.
under 100,000, 50,000, or big.
Yeah.
So this is an average, and so I think that it's not a weighted average, or median. It's a true average.
Yeah, my theory is that basically, like, we sold Alaska, and that has skewed all the other land notes in the portfolio somewhere. I mean, going on. There's some giant land out there that's did that.
Yeah, like I've seen a lot where somebody bought a big piece of land and they subdivided it and sold it off.
Yes.
And the only reason I haven't bought one of those yet is just I struggle to value it. Like if this goes south and I take it back and have to resell the product, what can I really like? I know what somebody actually paid for it. I get it.
Right.
But I just don't know. It's just
That's
not
a
my
good question to
wheelhouse.
ask. It's easier to buy when there are other lots that aren't from that same developer or that are selling. Yeah.
Right.
Yeah.
Yep.
Because they're kind of creating their own market.
Yeah, exactly. Like,
Yeah.
yeah.
And to your point earlier on people buying on rent, people buy, I mean, there's been a lot of people have sold a lot of lots based on, hey, for $200 a month, you can own this lot, up here. And it did not equate to the value, what should have been at all. So it's tough. If you don't have another developer or somebody in that area or something close to compare it to, We would tend to shy away from that because if I can't comp it against other developers that have actually sold, it's tough. It would be tough.
But we've done a lot of land notes that were
Oh, yeah.
very profitable. You really got to underwrite the down payment, the borrower's credit worthiness, that they've got the extra income. Like, you know, when somebody showed me a note on land the other day and they weren't making their house payment. Well, why do I think they're going to make their home, their land payment?
I wonder if that's almost, could that be like a little bit analogous to like looking at a second where it becomes like, not so much how much equity is there, but is the borrower the kind of person who's gonna pay this off
Yes.
one way or
Sure.
another? Yeah.
Yep.
Yeah.
Yep. And this is just a quick little chart that shows the average transactions by month for 2023. They're in the orange in 2022. You know, we've got seller financing all year long, but it tends to be that August and March are really busy months for seller financing, and some months like February are lower, but it happens all year long.
Yeah, I would have expected to see some kind of like smooth season curve, but doesn't seem to work that way for some
Yeah.
reason. Yeah.
And then we like to also talk about those top 10 states that you were interested in.
Yeah, so as I mentioned earlier, the top 10, 67% of them are the part of the top 10. That leaves 33%, make up the remaining of the amount. We'll break it down. We'll just show you what they are right here.
So 10 states make up 67% of the volume. That's pretty big. It's like that old 80-20 rule. So who's number one? Well, every year since we've been tracking this, Texas has had the most seller financing, and they came in at 25%. And that's about what they came in last year. And that's about what they've come in with the last 10 years.
And that makes sense to me, right? Because it seems like for the last 40, 50 years, Texas is like the hub of note. Like that's like ground zero for note investing.
Yeah, I don't think
that one
two
I get.
necessarily surprises anybody because it's Florida. You know, they're again retirement state. People aren't surprised by that as much. Number 3 always surprises everybody because it's California, and there's always
it surprises me.
Yeah, there's always that perception of California as, either it's a political thing or it's a dollar amount thing, whatever it may be. But California holds strong at number 3 and typically has for quite a while.
And this is by count, not dollar volume. This top 10 states
so those
by
are
count. So it's a
presumably
little bit more
larger.
true number than just dollar. You can see why California might run away if it's based on dollars, right?
Yeah, like if you hadn't showed me this data and I had to guess, like I would have figured California, like, okay, these are all properties that are like $1 million plus. So the bank's gonna do the loan, and yeah, the regulatory environment's probably tough. So maybe it's not as conducive to originating these. So yeah, I'm definitely surprised to see that one.
Number 4 last year was North Carolina, and number 5 was Georgia. Georgia had 4.5% of the count, and North Carolina had 5%. And then we just flavor in the remaining 5 states to finish out the top 10.
Georgia's, I was going to ask a question about Georgia's interesting to me too, right? Because aren't there some licensing requirements to own
There are for
notes?
note investors, yes,
But does
not
that apply if-
specifically to seller finance, but if you go to buy that note, yes.
Yeah.
Okay.
Yeah, it's interesting, George. So if you're not watching this, if you're listening to the podcast and you're actually trying to picture the map in front of you right now, forget about Alaska and Hawaii. We're not going to talk about them. If you're just picturing the map, you can largely start on the coast and on the West Coast and go down Washington, Oregon, California, Nevada, Texas, Florida, Georgia, North Carolina, and you can almost just go across the entire coast, lines. And those are the hot, within the top 10 states. Now, obviously, New York and Pennsylvania are a little bit different, but those, and it traditionally has always been stronger out west than it was out east, but that was for years, and now it's kind of moved over. But Georgia, to me, is always the aberration of like, okay, who went to Georgia, and that became a top 10 in there.
Yeah, my other question is like looking for the dog that didn't bark. Like, why wouldn't Michigan be on there? It seems like
They're in that next
There's a lot
layer.
of
The next layer, yeah.
okay.
Now remember, this is
All right.
count. And so, you start looking at not only, you look at dollar amount, so you and I would default to going California, that would make sense. When you talk about count, you got to talk about overall population of, say, a Michigan versus a Georgia or Arizona or something like that. Clearly more people in those states. So that helps sway the count because We haven't actually broken it down by per capita. Now that would be interesting. Notes per capita.
Next year we'll do that.
We always come up with something new. I just thought about that. I like where you're going, Dan. So now I want to
Yeah.
know per capita why Michigan's not higher.
I wasn't
So,
trying
yeah,
to
we
give
could
you
probably
more
look
work.
at
I was just curious. Yeah.
Yeah, per capita would be interesting. So, but if you look at the next tier, at the next 10, if you will, I think Michigan makes that next tier, don't they?
They don't.
They don't.
I
Never
didn't
mind.
see them on here. That's weird.
Yeah,
They're the next tier.
They're the next tier.
They're number 38
Yeah.
by count.
So they had 373 transactions.
But I will say one thing that could skew that were seller financed is that this does not include anything like an unrecorded land contract or contract for
Which is
deed.
more popular.
In Michigan, has a
Oh.
lot of unrecorded land contracts or contract for deeds. If there was a recorded contract for deed, we pick it up. But if it's not recorded, there's no way to pick it up. So I think, honestly, for over 30 years in business, I think Michigan would be probably in the top 20 if we could somehow find all those unrecorded land contracts.
Well, it's interesting you say that too, right? So that means the seller finance market is actually larger
Yes.
than what
Yeah.
you're showing here, right?
It
So
is.
it's actually something bigger than that 28 billion. You can't pinpoint what it is, but
Yeah, you can't see what's not recorded, but this would be the low end because this doesn't include seconds and it doesn't record unrecorded land
And
contracts.
nothing under 30. So one point I want to make real
Mhm.
quick, Dan, because to come full circle on what we talked about, starting with the overwhelming number and breaking it down farther and farther and farther. The 25 billion is overwhelming. You're like, I don't see that around me. You think realtors would talk about it more. You think, but if I break it down and go, okay, New Mexico, that's only 229 transactions that go into the bucket for New Mexico. That's
Mhm.
only 542 for Arkansas. If we go in, even if we go all the way into the top 10, that's only 2,100 for Oregon for the whole year. So you can see as you add them all up together now, you're like, okay, I can see how we could get there because it's not a huge number, any individual state. Now, Texas is 22,000. That's a lot of transactions.
They do everything bigger. Yeah. So
They
that's
do.
the thing. Yeah.
And it's a big state.
So
Yeah.
there's this saying of like, well, why is Texas always so big? Well, some people say activity breeds activity, like they've been doing seller financing so long, they have actual laws about it. When you talk about a wrap where somebody buys a property subject to and then resells it, they get a payment, make a payment to the underlying. They actually have regulations on that. They have disclosures. They have servicing companies. They have people that understand how to underwrite it. So when you do something long enough, then it becomes more normal. But there's other reasons in addition to that. One, Texas is definitely a big state, but also they have a clientele there that tends to use a lot of seller financing. So they have a lot of
Mhm.
people there that, may not qualify for bank loans. And so we see a lot of ITIN or ITIN buyers there, or people who are self-employed, or maybe don't have a traditional W-2. And so, a lot of the states that you see with a high number of seller finance deals, that's a portion of why they come in there.
And that probably explains Arizona somewhat as well. Plus being a retirement state like Florida in there. Yeah. But I would agree with that. I think, it's interesting how many people don't even realize that seller finance is an option. They don't even know that it's a thing.
Yeah.
So when you have a state where like a lot of people, like if everybody knew this was an option, there would obviously be way more volume than what's here. So it makes sense in a state like Texas where people have been doing it for decades and there are just more people who know that it's something you can do, that they're going to have this much higher level of activity.
Oh, I think you would have, another 15%, at least 10% more of transactions of people realizing they could sell a house and carry back a note secured by the house that they know and love and get, 8% on their money while they're, over a period of time or whatever. I think a lot of people go, well, that's a lot better than me putting in a savings account or even a CD. It's, twice what a CD is right now almost. So,
Mhm.
yeah.
And that sort of leads us into who is creating these seller finance notes and how do we get more of them or how do we find them? And that's, you were kind of asking. So we're going to talk about who creates a note and whether they do it as an individual or an entity. And so what we found is that about 86% of the notes created last year, it was what we call a mom and pop seller that just do one in 12 months. And that might be the only one they ever do. Maybe they'll do another one, but they're just doing one in 12 months.
Mhm.
Yeah. And then what we did further, we started doing a couple years ago, is we go, okay, well, who's creating more than one note? And what we found was that roughly 14% of the notes created are people that created 2 or more notes. And we broke it down even further than that a little bit, going, okay, who created 4 or more notes? So, 8% of the 14 were between 2 and 3. And 6% of the 14, or the overall, are 4+ notes. And we consider those kind of professional sellers. When we're looking for somebody to buy notes from, we're kind of hoping to stumble on one of these, because this is somebody that could sell us more than one note. And sometimes we'll have, we talked about list and using services to do that. We'll have them pull a list of somebody that has multiple notes, and we'll write a marketing letter or something to, market them, knowing they have more than one note, and try to get more, purchase more than one.
It's also
Mhm.
important to think about too, because this has to do with Dodd-Frank. So while we want to be sure everybody has the ability to repay when we're talking about a homeowner living in the home, the rules are different if it's an investor who's buying the property. But if the homeowner's living in the home, Dodd-Frank has some additional restrictions if you're doing over 2 per year, or if you're an entity, and up to 3 per year. So that's another reason we kind of break that out. And we've watched over the years to see if this has changed much, especially since Dodd-Frank took place.
So is the
And
3 per year rule still in place? Like I've heard, I haven't followed it closely. I hear rumors now and then that they're gonna like expand it to like 20 or 24, but
it
that hasn't
hasn't
happened
been
yet.
yet. There's
Okay.
there's legislation through the Seller Finance Coalition that's currently a bill to ask for a higher exemption up to 24, but no, it has not yet been passed. But that law still stands as it was written.
Gotcha.
Good question. So we can just see it kind of bumps along very similar to those numbers, the mom and pop versus the multi-note creators. We like to think the multi-note creators are doing all the right things, like you mentioned, making sure it's Dodd-Frank compliant. Those single note creators don't always do that. So when you go out and market to them, you got to really watch those single note creators to be sure they really did make sure that a homeowner has the ability to repay, or it's an investor deal.
Mm-hmm.
So the other thing we started to do is look at it by entity. So of the people that were creating the notes, 57% of them were individuals. That's just the way all the documents were read as individuals. 32% were a corporate entity, so they could have been LLC, and
11% were in a trust. So you see a lot of trust, anything that would be an IRA deal, equity trust
Okay.
company for the benefit of, or Quest Trust for the benefit of, or New View, all those ones that are out there. Anything
Mhm.
like that would be, considered a trust. Other people use those types of trusts just to take title for anonymity purposes. Corporate entities would be things like LLCs, S corps, partnerships. But
Mhm.
yeah, people are surprised that it's, 57% are individuals. But remember, 57% are individuals, but 86% just create one in a 12-year period. So, there's people creating one in a 12-year period that are still using corporations or trusts.
Yeah, it's fascinating there are this many individuals doing it. And I
yeah.
don't really have a question or a comment here, but it was back to our earlier talk about how it seems like banks are fulfilling less and less of the role that they traditionally have. Some of that's being replaced by seller finance.
Mhm.
I'm like, why aren't more corporate entities showing up to fill in some of the blanks? Yeah.
Yeah. And remember, this doesn't include any private lending. So we're talking true seller financing. When you add on top of this number all the private lending that goes on, those numbers would be, again, much, much higher. So what's happened in 2024? That was the question everybody had.
Yeah, like if we were to put on to wrap things up, kind of put on the crystal ball type thing, and then also give everybody a link where they can download these slides. Interest rates, are probably pretty stable to where they are right now. I mean, the Fed has talked about lowering rates a little bit, but it's not going to be to 1-to-1. So if the Fed was to lower 100 basis points, so with roughly 1%, you're not going to see mortgage rates or the availability to get a mortgage go down a full percent. Banks are going to be more cautious. They want to make up ground for putting out low loans that they never wanted to begin with, that they've still got on their books. So, inflation has roughly leveled out, it was a high of 9 coming out of, post-pandemic type stuff, and, the surge pricing, and then people, I think, price gouging along with that. but that's leveled back down. But I think the inflation still has a little bit of a factor. So both those two things come into play.
So you're saying that like if inflation or if interest rates were to go down, banks might tighten up because now they really don't want to lend at that lower rate?
I don't think they're going to tighten up, but I don't think they're going to be loose equal to the amount that the Fed comes down.
Gotcha. Okay.
Yeah.
So
Yeah.
interest rates coming down makes availability usually go up because your payment goes down and more people can afford it based on their income. But
Mhm.
there's the other side of that, like Fred's mentioning, that what's happening in the banks right now isn't just tightening of credit availability because of interest rates, right? It's also because there's not as much buying of conventional loans on the secondary market. Fannie and Freddie who are the big buyers of bank loans, have been told to pull back how much they're buying. So there's not as much liquidity. And when there's not as much liquidity, that's when those banks tighten the market. And that's why Fred's saying, like, we're not, even if the rates come down, I think, yes, it'll be more affordable for the buyer's payment. But that doesn't mean banks are just going to open the doors and lend a whole bunch. Plus, they don't want to have a bunch of low interest rate notes on the books, as he mentioned. They
So-
want to see where it's going to level out.
Yeah. So what, I feel like a 2-year-old, cause like I keep asking why on all this stuff, but like, why do you think that Fannie and Freddie are tightening up and not buying as much? So the
Ah, that's
liquidity is
another.
going away. Yeah.
That's another hour.
So you
Okay.
why does the federal government do what they do? All right.
Yeah. Okay. Okay.
Well, that leads us into the other sad face on this slide, politics.
Mhm.
There's a lot of politics that happen. It's an election year, so there's uncertainty in our nation. There's uncertainty globally. There's uncertainty in commercial. There's uncertainty in banks out there that sold off. That we had the banking crisis in 2023. So all of that uncertainty means it tightens up credit availability and the secondary market. And so for us, when we look at these things, it's harder to get financed. Certain markets are softening, not all, it depends, it's very regional. The one thing that's bolstering that ongoing increase in residential values has been low real estate inventory, right? That's why values have been going up, but they are softening in some areas. But when we put all these things together, we just talked about, that's why we feel that seller financing will be similar to last year or increase in 2024.
I think
makes
that
sense.
to continue on your question a little bit, I have one word and it's sandbagging.
Okay.
And the reason I say that is that, look, a lot of banks, a lot of positions of people in banks and or government got really burned by how low rates went. Too much money is out there. So two things have to happen. One is when they see everybody else dumping and taking losses, they dump and take losses because it's not as bad to the public if it's a public company or it's a government, because like, hey, I get it. Everybody's getting hit right now. You're not the only one taking losses. So they blow everything out they can at that moment to then go, hey, look how good we look going forward. So they get that bump. And then the second part of that is that, hey, I've seen this road we're on again. I'm going to be ultra cautious, maybe even more so than they have to, but I'm not going to get burned. I'm not going to be the last person when the music stops, not finding a chair again. So they're just going to be a lot more cautious before anybody opens up the floodgates. And if you didn't qualify for a loan at 7%, you still don't qualify at 6% if there were all the other check boxes you weren't meeting, other than the payment being $200 less or whatever it may be.
So we love doing these stats because we use them as investors to figure out what our market's doing and where we see opportunity, and we continue to see opportunity in seller financing. If your listeners are listening and they're not just note investors, maybe they're buying property or they're selling property and they're thinking, how can I apply seller financing to that? And so we can kind of look at these and we can see where the trends are going. And every year we make these stats available. We actually let people download them at our website, which is noteinvestor.com/stats, STATS. And you can download those stats. And people think, well, why do you share this information? Well, we can't buy $28 billion worth of notes. There's lots of notes out there for everybody. We all just need our piece of the pie. And I think by educating people like you do, Dan, that people create better notes, and better notes are better for the buyers that are making the payments. they're better for the sellers collecting the payments, and they're better for us as investors when we go to buy those notes. And so that's why we think sharing this information is so important, along with how to create a best possible note, so that we're all doing it well. Because I'd love to see Main Street seller financing take over the Wall Street bank financing, but we just do that by getting better at it.
Yeah, I agree. And it's kind of like we were talking earlier about, Texas has had this critical mass, like people know it in Texas, so they do it more. I feel like if more people
Sure.
know that this is even an option, then the market will get a lot bigger for everybody. Yeah, because I can't buy 28 billion in loans
Yeah.
either. So
Maybe next year, right? Yeah, yeah.
maybe just 1 or 2 billion this year, and then yeah, we'll see. Yeah, just cool. Well, anything else, like where else can people find you? I know you guys offer a lot of training in doing notes and some different workshops and
Yeah,
things like that. Yeah.
That's the best place, matter of fact. If you go to noteinvestor.com/stats, I'll make sure you get a notification. We're about to go. We have a membership that we only open up twice a year. It's not a big secret, is that we don't outsource anything, so it's just Tracy and I that work very closely with our members. A ton of education stuff, but we do, right before we open up the doors, we do what's called lunch and learn. So if anybody's interested in learning more about the note industry, we do about 4 or 5 webinars over a period of a couple of weeks, where we basically give you all the information. I mean, how to find notes. We'll do a little bit of this session in the first one, then we'll talk about how to find notes, how we market for them, what the numbers are, how much you make, don't make, invest, don't invest, whatever it is.
How we
But if you go to noteinvestor.com/stats for this, and you go ahead and just request this copy of the slides, I'll make sure everybody gets that invite when we open up the doors, because we don't usually keep it a secret, but we only open them up for about 5 or 6 days. And then we close the doors, and we really do. It's not one of those things that, you can keep getting.
And we'll be sure to give you a link too when those lunch and learns start, because you're welcome to invite anybody you want to.
Perfect. Well, thanks guys so much for joining and sharing all that information. That was terrific.
Yeah, thanks for having us.
Thank you, Dan. We appreciate you having us here, and you keep sharing all this great information I know you're out there doing, and thanks for hosting the podcast.
Yeah, anytime. You guys, keep going at it as well. So appreciate it.